You know, if you follow this channel, that there's a lot of pain coming to the multifamily space. The pain will probably be greater on a numeric basis than the '08 crash. But the real question you need to be asking is, okay, great, a crash is coming, but how do I take advantage of that? Well, good news, folks. We have Jonathan Twomley here who has done the work, has been in this space for a long time, and we're going to be able to pick his brain to figure out how you can take advantage of what's coming. Jonathan, thank you for being here.
And as always, happy to be here.
Yes. So Jonathan, just real quick, if somebody's just tuning in for this, remind folks what you do in this big world of real estate investing, and then we'll get into why you are the guy to help us all figure out how to take advantage of this.
Sure. So I've been doing commercial real estate since 2011, uh, mostly investing in multifamily. I built a portfolio for myself well, not all myself, it was investors in the deals in South Carolina, which I sold for COVID. And I've also raised capital for other deals for probably getting close to $300 million worth of deals that I'm involved with. And more recently, I've been focusing on value add hotels, but I have a long, history working on and thinking about and watching the markets in commercial real estate. So that's the background.
Yeah, and the reason why you're the guy to talk to is you're conservative, right? You saw value, you build a big portfolio, then you saw some excess value, or at least what you thought were deemed excess value. You took your chips off the table.
Yeah.
Then, like me, for a couple of years, it was really hard to do anything when all of these other syndicators were overpaying, getting bad debt, bridge debt. You and I were warning people what were coming. We actually did a video, I think it's been 18 months ago, how we turned a $100 million building into a $48 million building with just very small tweaks. And
And,
that is
and
all
it's
coming
happening
home
now.
to roost. Yeah, it's
Yeah.
it's happening right now. Okay. So my
So
audience gets it.
I'm
Go ahead.
sorry. So I just want to add one thing to this. You know, you and I have been talking about this for years. We were talking about when people started putting bridge debt on deals and when they should be using permanent debt. We were talking about the dangers of this and going on, 3 years ago, I think we were talking about this. It's funny, somebody posted on LinkedIn the other day, like, hey, who could have blamed syndicators for putting on, short-term floating rate bridge debt a couple of years ago because nobody could have foreseen this coming. And I was like, hi, you can
Hello.
you can go back and see like several years of videos of me and
Yeah.
Mike Super talking about this very issue when it happened. But it just goes to show you that there's just a lot of ignorance about
Yeah.
how debt works, how markets work, and from among people who raised millions and millions of dollars, in the last cycle. So anyway, just as an aside, I know
Oh, I
you're
think
going somewhere
that's
with this.
yeah, this is important, right? In social media, it's not sexy to be calling something early and warning and saying, don't do that, don't do that, the hot stove. It's a lot easier to drive around in your Lamborghini and your private jets, telling everybody the world's okay. Oh, by the way, you get your fees. You probably have no skin in the game, and now you're just going to walk away, and you know, it's just sad. We warned, we were right, we got receipts, but you know what? That doesn't matter. How do we help people take advantage of what's coming?
Yeah.
Because I still think we're in the third inning of a 9 inning game, to use a sports analogy, which means most of the pain is still ahead of us. So, what should people be doing today to learn and get ready, Jonathan?
Yeah. Well, there's a number of things. And for people who are skeptical still about like how bad multifamily is getting or is going to get, multifamily has actually lost more value than office in the
Oh,
last.
by a mile,
Yeah.
yeah.
Yeah. I mean, which is just kind of astonishing if you think about it. Even though you've seen these high profile deals where, a $250 million office building traded for $3 million, like those are extreme cases. But as a broad proposition, multifamily has lost more value because it was bid up too high, right? I
Yeah.
mean, but okay, so that is the background. What do you want to do now that the pendulum has swung in the opposite direction, and it's going to be there's going to be deals coming onto the market that are going to make people rich. because you're going to get them at good
Oh,
valuations. And that's really what the game is all about. We haven't seen this kind of opportunity since the great financial crisis. And as you said, probably it will be a bigger one. But it's going to be a little bit more of a hidden one, I would say, because I
oh,
think,
I totally agree. I think that is the key. That's why I wanted to talk to you about this. This is not the Great Recession where you're going to see single family homes just throwing up on the market. It's not in single family this time, folks. It's
yes,
in multifamily, and
it's,
it's a club,
yes.
right?
And
Whether we like
it's,
it or not, it's a
but
club.
not just that, it's not just that it's a club, because back uh, in '08, you saw a lot of multifamily coming to the market too. It just wasn't
Sure.
as big a thing as single family, right? But it's going to be bigger this time, and it's going to be more underground. So what do I mean by that? The banks understand that if they flood the market with foreclosed properties, they will, undermine their own balance sheets, right? Because they don't want to
Correct.
foreclose at a certain valuation and then flood the market and push the market down on the assets that they're holding, right? That would be catastrophic. So they're not going to do.
Catastrophic. Yep.
There is already, and there will continue to be, extend and pretend for loans in the hopes that they can kind of dig themselves out. Now, what's going to happen with extend and pretend is a couple of things. At some point, and I'm thinking that this is going to be around 2026, 2027, the money is going to have to come. Like, those lenders are just going to need to get that money back, and they're going to start pushing sellers to sell and maybe foreclosing on some
Mhm.
deals, right? That's just because they just need to get that money back and redeploy it. I think also, even though this is the wrong move, a lot of deals where the owners have been scraping by the skin of their teeth for several years. As soon as they get to a point where they can sell them, where they're back above water, they're going to sell. That's the wrong
Oh,
move. They should hold them because they should just hold it for the run up. But psychologically, they're going to be like so relieved that they can
yeah.
get out, get their investors' money out, maybe, or most of it, sell for break even or close to it. They're going to be like, okay, we're out of here, because the investors are going to be all jittery.
Clamoring.
They
Yeah.
want my money, right? So you're going to have a lot of sales like that are really kind of rushed and not well thought out. But how do you take advantage of this, right? This is going to be,
Let me, yeah. So let's get to that. I want to go back and make sure I heard your timing right, because that's interesting. We're obviously recording this in May of 24.
yeah.
I thought I heard you say this, it may get on the boil in 2026, 2027.
Well, for what I meant specifically was the all the deals that are on extend and pretend,
I
right? So
got you.
there
Okay.
are other deals, yeah. I think there are going to be other deals coming through, because extend and pretend is only going to apply to the deals where the lenders feel like if they extend and
It's
pretend,
exactly
they'll get their money back, right? Now,
correct.
when you're looking at deals where it's like, you know, they don't trust the operator, or the operator has done a terrible job, they're just going to say, we're just going to cut our losses, get back what we can, and redeploy that capital now at higher interest rates, right?
Mhm.
Um, so those deals are going to start coming through the foreclosure system. Now, how do you access those deals? There's a couple of ways. Some of them will go to brokers, right? So you want to make sure that you're talking with brokers, right? You want to make sure that you're talking with brokers now and building those relationships, because the people who are going to see those deals are the people that the brokers know. And if you show up in 2026 saying, "Hey, show me, you know, distressed deals," they're going to be like, "Who are you?" Right?
Correct.
Start building those relationships now so that you're on the list, right? And you get access to those. The other source for these are going to be the lenders themselves, or
Mhm.
the special servicers. So for most people who are listening to this podcast, probably not going to be um, doing super large deals. This is going to be, you're going to go talk to the local banks in your area and say, "Hey, who is it who handles your real estate owned portfolio? I want to meet them," right?
Yeah.
And you want to start building relationships with those people, because those are the people who are going to be responsible for disposing of these bad loans, right?
Yep.
These bad properties. There will also be an opportunity to buy the debt too, but that may be a
Mm.
more costly proposition, because you've got to come up with more money in order to buy the loan, right? You may get a bigger discount on the property, but you have to come up with more money. But that's also an opportunity potentially to get control of these assets is actually to buy non-performing loans and then foreclose yourself, right? But
Mhm.
you can't finance that. You got to come with cash.
Yeah.
So, um,
I just let me stop you right there because again, one of the things I want the people watching this to understand is we talk about 100-unit buildings and 300-unit buildings, right? The big stuff where the big players are. I want people to realize the same nonsense that happened there also happened in your 5 to 40-unit buildings, and
absolutely.
those are too small for the big boys. They're going to be ignored. So
Yeah.
I want people to realize it's out there, right?
Yeah.
It is something you can play in, and I did several deals in the last cycle, between 10 and 18 units, a couple directly with banks, couple with sellers who had to foreclose on other private sellers. It's coming.
Yeah.
So do the work now.
Yeah, it is coming, and I mean that's just such a great point. Like there for any loans that like the federal agencies won't do any loans that are under $1 million, and realistically speaking, they won't do any loans under about 2 million at this point, even though technically 1 million is their cutoff, which means that all those loans for anything that's smaller than that is all with local banks, credit
Yeah.
unions, places like that, um, and it's very fragmented, and that's good because it means that it's unlikely that those those lenders are going to have like a huge portfolio of smaller properties that they could then go sell to private equity or something like that, right? They're going
Yeah.
to be having like onesies into like a lot of these little deals kind of poking around, and their interest is to just get them off their balance sheet fast, right? Get
Mhm.
them off their books fast because they don't want to own properties. They don't know how to operate properties. It's just not in their sort of DNA to think about
Mhm.
like, oh, let's increase the value of this property.
Mhm.
They know that they're not in that business, and that these
Yeah.
assets stand the chance of deteriorating under their watch, and then it gets harder and harder to sell. So they're going to
Yeah.
want to just turn them around as fast as they can, which means that you got to be in the right place at the right time. You have to be talking to these people ahead of time. So
Yeah.
so sourcing those deals is half of the equation, right? And talking to those people, talking to the brokers, trying to find the brokers who are connected to the banks who are going to be listing these properties.
Yeah, let's poke at that a little bit because again, I'm trying to help the average person kind of figure out what they could like an action step.
Yeah,
One of the things that I noticed in my market, and I'm coming to you because I only know one market, you have experience in a lot others, like residential real estate, the single family home. There's thousands of agents, and
yeah,
there's a couple, a big agent or a big broker will have 10 or 15 listings. What I found in the commercial, again, 5 units and above, in Fresno, which is 1 million people, there was like less than 10 agents, and I want to
right.
say it was less than eight that controlled like 80% of the
Oh
listings.
yeah, yeah, absolutely.
They're not
Because
hard to find. Go find them.
yeah, exactly. They're not hiding, those guys, right? They're easy to find, and just with a little bit of talking to people, you can probably, if you can't find them directly just by Googling, you know, but here's another thing that's interesting is that you'll often find that the people handling commercial stuff um, are not even located in your town, right?
Correct.
They're because you may only have, you know, a few brokers in a whole region for for multifamily, right? So just go out and find them. It's not that hard, but you got to find them. Don't limit your search to like your town or whatever, because you may have to search a little broader than that. And it's kind of weird where you never know who's got a relationship with who. Like the bank. This property in your town the bank may be at the other end of the state, right? And it's listed with a broker there, right? Um, so it may take a little bit of hunting, but the thing is, for those, what's going to come through the brokers is kind of like those forced sales, right? Where the
Right.
bankers lean on rather than the foreclosures per se. I mean, even though some of them will come through as well eventually, but what you're going to see first is where the lenders are leaning on those sponsors to sell, and we're making it clear that like we're going to foreclose, and then the sellers themselves are going to be like, we're going to try to sell before it happens, right? Because they don't want a foreclosure on the record, because then it makes it very hard to do business again. So um, that's one avenue. One thing I didn't mention, which I should, also, so obviously you want to talk to the bankers themselves, also property managers, right? Like the
Yeah.
property managers are going to know, which deals are in trouble, right? And and then to some extent, like lawyers and CPAs as well, right, are going to know, the CPAs especially, they're going to know which properties are struggling, right? So those are kind of like your sources of potential deal flow. But
Yeah.
it's really the brokers and the bankers that are going to have the most of it, and you want to cultivate those relationships. Now, the flip side of this is you've got to get the money, right? You've got to have, and if you're fortunate enough to have the money yourself, then, well, here's what you do to figure out what you can buy, right?
Mhm.
You're For a commercial loan, what the banks lend on is your net worth. So it's the cash flow from the property and your net worth. That your net worth is the upper limit on what you can borrow. Your income is not as important because they're looking to the property
For
itself
the building, yeah.
for the income. Especially with smaller banks, these are generally recourse loans, right? So you're going to be limited by your net worth as to how
Yeah.
much you can borrow. So figure out what your net worth is, and then that's the size of property you can look for. And then you ask yourself, do I have the cash to do it or not? If you have the cash yourself, that's great. If you don't have the cash yourself, okay, go and start partnering with people. Find other people who are interested, explain the opportunity that's coming, and start lining up people who are interested in going in on this with you, and really get them to understand that like this is a really really unique opportunity. This kind of thing happens once a generation,
Hmm.
and if they don't jump on this one, they're going to have to wait another 10 or 15 years for the next one.
Yeah.
So
I
and this
really do think this is the generational opportunity, right? I've been doing real estate for 20, almost 25 years. This is the multifamily opportunity, right?
Yeah,
This is what books will be written about, right? There will be billionaires made and plenty of millionaires made who take action and get educated and just frankly do the work. Um, it's coming. It's going to be
yeah.
massive.
And I think that so many lenders are going to get burned in this cycle that we're going to see the same thing that happened after the great financial crisis. So in the great financial crisis, they really tightened up lending standards a lot.
Oh, yeah, they did. Yeah, they
And
did.
and they made it, they instituted things like, even for non-recourse loans, you still have to have a guarantor. There are certain like carve outs from, there's no such thing as a completely full non-recourse loan in commercial real estate anymore because of the shenanigans that happened during the great financial crisis, right? So this time around, the standards are going to get tightened again. Maybe they're going to cap leverage at a lower level. I mean, who knows what's
Oh,
going to
for
happen,
sure. They're going
but
to over rotate. I mean, again, the last cycle was very much residential, so I felt it. Almost overnight, they suddenly said you can only have 4 loans,
yeah.
right? Overnight, lending products disappeared, right? It's going to come to commercial, right? Once they realize that they can't extend and pretend they can't, there's no magic, rate, 100 basis point rate cuts coming. Um, yeah, you're going to see, we're going to talk about that in the next video, but yeah, the lending is going to get harder,
Yeah.
more expensive, and just more uncomfortable for
Yeah.
probably quite a while.
The lenders are going to want to build in a lot more safety, right? So you're going to see lower LTVs. I think you're going to see like interest only disappear,
Oh, for
right?
sure.
You
I
know,
agree.
you're gonna see a lot of like it's gonna just be much harder to get floating rate debt,
Hmm.
and um, I I just see them overcorrecting in the other direction, right? So um, that's you know that's
Yeah.
definitely going to take its toll. Now, one last thing I want to mention too is that I think there's going to be opportunities in multifamily if you are talking to the right people to take over buildings without really any money down,
Hmm.
because
I
you'll be able
agree.
to just assume the debt, right? And maybe they're going to require you to put up some money for CapEx, but
Yeah. And again, I've done that. I want people to realize that this is not two guys that just are thinking about this stuff. I have actually done that exact deal. I worked with a bank, a small local bank in Fresno, California, who had a 10-unit building next to a 10-unit building I was turning. The bank president called me and said, I know what you paid for that building. Do you want another one? And, we talked this, that, the other, gave me 100% loan. The only thing I had to do, Jonathan, was put 50 grand in his bank for CapEx,
Yeah.
which I would have done anyway. I just moved money from bank one to bank two, and bingo, bango, I got another 10 unit building. It was the easiest loan I've ever done. It's crazy. It's
Yeah, I
coming.
think those opportunities will be there. And if you're, you know, if you let's just say you're, I know there's a lot of people out in California listening to this, right? Because you're in California. Let's just say you're like you work for a tech company in California and you make a decent salary, right? And you've got some savings and you have a decent sized net worth. I think if you are a bankable person with a steady income, good job, and a decent balance sheet, you'll be able to do those deals, right?
Oh,
And,
absolutely.
and yeah, so don't think that this is beyond you, or that the banks are going to be looking for people who can pay the debt right on the next go round. And
Yeah.
if you're in good financial shape, then and you develop these relationships, which is just critical. Like they're not going to just come to anybody. They came to you, Michael, because maybe you didn't have the relationship, but you were known in the community because you
I was
bought.
known in the community. I had evidence. I didn't know this bank, but I knew other like banks that they networked with. So I'm sure they researched me personally. And yeah, it was just a very easy conversation.
Yeah,
And I didn't even have to negotiate. I think the only thing I negotiated was a quarter point off the rate. I
yeah,
was like, I'll take, sure, I'll take that building for the same price. I got the last one for a steal. Yeah, it's coming. So again, folks, there is a lot of pain coming. Jonathan and I warned you. In fact, we have a video that's almost 2 years old that showed you $100 million building becoming 48, and it happened. But now it's time to get ready because the opportunities are coming. It will be the generational opportunity in multifamily over the next several years. Jonathan, where can people follow you and find you?
yeah. Well, these days where I'm hanging out is on LinkedIn. I'm posting more or less every day, commenting all the time, building relationships there. And if you'd like to connect with me, just reach out on LinkedIn.
There you go. Thank you, buddy.
Absolutely.